A follow-up this morning to a question we asked during the first Trump administration. Are the president's social media posts criticizing Fed Chair Jay Powell and the central bank driving down interest rates? Senior economics reporter Steve Liesman is here and looking at the bond rally and presidential pressure on Powell. Stupid mule, I guess, is the latest salvo.
I didn't see that one.
You didn't see stupid mule?
Was that last night?
That was last week.
Yep.
Oh, last week. We looked at all of them. There's
a lot of them.
Maybe we're one short.
Them,
but
yeah.
June was a month of historic, intense bullying by the president of the Fed chair to cut rates, and bond yields fell sharply. So is it working? CNBC counted 10 times, maybe there's 11, when the president, in ever-growing stridency, criticized the Fed in tweets, press conferences, and TV interviews. Take a look at the graphic here. On the 4th of June, he said, too late, Powell must now lower the rate. On the 7th, he said Powell is a stupid and bad person. On the 24th, we'll be paying for his incompetence for many years, and there's others up there on the screen if you're driving by radio. Well, a research paper by Francesco Bianchi from Johns Hopkins, along with two other economists, found that Trump's first-term tweets, quote, had a large impact on U.S. Treasury futures for medium to long-term maturities, and the effects increased with the horizon of the interest rate. They found Trump's comments moved Fed funds futures lower by 2.6 basis points. Only 5 of 50 macroeconomic events they studied, had bigger impacts than the tweets. Most sensationally, they concluded that the tweets helped partly explain the Fed's reversal in 2019 when it cut rates, which Fed officials, of course, have denied. But casting doubt on the theory, there were other events that moved yields in June. Take a look. A weak ADP report on the 4th sent them lower. They rose after strong payrolls on the 6th. They fell again after good inflation and after Iran hostilities ended. And, of course, Powell's testimony as well. Strategist Peter Bookvard told me, we go through days where the bond market trades on deficits, the weaker dollar, and weaker growth, moving in different directions on each one. Now, Professor Bianchi tells me it may be that the effect is less pronounced in this term because inflation is higher and you have those higher deficits and tariffs, which makes this really a bond counter rally. But the president is also making more and much harsher comments. The market could also be starting to anticipate what a Trump-appointed chair will mean for rates down the road. And all of this raises the question, if the president's comments do affect the Fed, what does that say about perceived or actual Fed independence?
And that's where I was going to go. Last night, we had a conversation with Rebecca Patterson on Fast Money, and she made the connection that it would make U.S. assets, specifically treasuries, less attractive to foreign buyers if the Fed's independence were questioned at all. So if there is that grain of doubt and it blossoms a little bit because of this, then other outside investors may be more reluctant.
If that's true, which makes perfect logical sense, then how did the bond yield fall over that period of time when you had higher deficits for sure ingrained in the budget, a weaker dollar, and more Trump tweets with more pressure on the Fed?
Right. But if he appoints a Fed chair early, if he announces his nominee early, then that could cast more.
But isn't the bigger
doubt.
question whether it's already baked in? This is what we talked about yesterday. It's baked in already.
What's baked in?
Which part?
There's going to be a different there's going to be a different Fed head in a year from now.
Sure.
This is.
Right. Well, then we're looking at, in the bond yield declining, the baking in of what you're talking about.
And that person invariably
will
who will by default have to have made some kind of blood pledge to the president that he is going to or she is going to lower interest rates, like full stop.
Well, let me work through one scenario that a guy who trades billions of these things told me yesterday. First of all, he doesn't think the Fed itself is having tweets themselves are having a big. He thinks that 418, 420, where we were a day or so ago, is just the bottom edge of a range that goes from 418 to 460. Yeah. And it's very hard to sort of pin anything down. But picking up on what Andrew was saying, the notion of they're going to lower rates over time, which will pump up the economy and the stock market going into the midterm elections.
Yes.
And then you have inflation on the back half of that. But you don't pay a price until later.
Right.
And so all of this would be some kind of, it doesn't matter now.
Right.
Now, I think Melissa's right, though. Over the long term, you have this degrading of U.S. assets and their
and then the deficit, of course.
Right.
Can I ask one other question? My understanding, unless I don't understand.
It's your show.
No.
Of course you can ask another question.
Is that the Fed unto itself is not a monolith. There are other people that are governors on this board.
This is a great question.
Even if you install your blood brother who's made this pledge to you that you're going to lower interest rates.
You've already got at least 2 members.
It's going to be 4. It's going to be 4 of 7 will be Trump appointees. You'll have Bowman and you'll have Waller, both of whom were Trump appointees. And then you're going to have Powell's going to leave. That'll be a third. And Kugler's going to leave in January. That's 4 of 7 board members.
Okay. So
and then what you'll have, Andrew, one way to think about this is a kind of more united governor group and a more disparate presidential group, or a group of presidents that may not be quite as united in their sort of thinking about things. Look.
But they don't have to go. Meaning, Amy Coney Barrett doesn't. Doesn't.
No, you're right.
There are people who do get appointed who don't do exactly what the president wants in every given moment.
There's a deference to the chair as part of an effort. The culture of the Fed is one of consensus. Right. And so you have weird things that happen. Is that, let's say we disagree over policy now, and I say to you, Andrew, vote on this one today, and I'll put a paragraph in there that says next time we're going to look at your issue more carefully. That's what happened under Yellen and Bernanke. And the statement got to be 2 pages long. Now,
but isn't that like a Supreme Court ruling half the time?
Well, it used to be. Not anymore. Now, of course, the Supreme Court is just completely divided, right? But the Fed still has this thing. It's sort of like the last consensus operating agency or department in the government right now. So there's a deference to the chair. The chair comes in. They're going to try to think about a way they can agree with him. And there are things the chair can do. I'm very fascinated, by the way, on whether or not Powell finds a way to keep Waller and Bowman from dissenting in July when it seems like they want to cut. Do they not? Do they cut, or do they end up finding a way to put that paragraph in the statement that says we think we're going to be okay here and signal cuts in the future, which might mollify them and make it so that it's a consensus vote? Very rare. And by the way, I think we reported on this several times. Powell has the fewest dissents as a percent of total. So he's really good at creating this consensus. Does somebody come in and say, I want to run this a different way? Volcker had almost double the percentage of dissents that Powell's had. So he's like, all right, you agree with me? Fine, not vote against me. I don't care. With a cigar in his mouth.